Hello, I'm Kathryn Rooney Vera, Chief Market Strategist at StoneX. Here's where the markets are right now, and here's my outlook going forward. The consensus spent virtually the entire year talking about stagflation or recession, principally stagflation. I've been worried about the opposite. The bigger risk, in my view, since January has been the risk of overheating. And the data as of June 16th today have really backed that view up. Growth has been running every quarter in recent quarters above 3%, well above potential, which is about 1.8 to 2%. Unemployment is still at a very low 4.3% versus a neutral, which is generally considered to be 5%. 5% being the NAIRU, the level or the percent of the labor force at which unemployment is neither inflationary nor deflationary. We're below that. The deficit with above potential growth and low unemployment is at 6% of GDP. That's not an economy sliding into stagflation. That's not an economy in recession. That's an economy still running hot. So you have right now both demand inflation and supply inflation. Demand inflation coming from a still robust economy and a still low labor market, and supply inflation coming from oil prices, which yes have dropped because of the planned Iran deal. But that doesn't affect the second order impacts, which are still in the pipeline from the increase in oil price that we've seen for the past 3.5 months. Also, the increase in food prices, which are still in the pipeline. So the real question this week, and remember, today kicks off the 2-day meeting for the Federal Reserve here in the US. The real question this week, when the Fed comes tomorrow and Chair Powell has his first presser, isn't when the Fed cuts. It's when the Fed hikes. And this is the first meeting in years where the live debate is about a hike, not a cut. In fact, a survey that John did of former Fed officials came back 17-1 hawkish. 17 former Fed officials expecting 50 basis points of hikes this year, and one expecting a cut. The interesting thing here is that Chair Warsh has explicitly indicated that he likes Alan Greenspan's opacity. Alan Greenspan famously said something to the line of, if you understood what I'm saying, I misspoke. Something to that effect. Essentially, what he believed in was a Fed that surprised, didn't dictate its moves. So, but the difference here is that Greenspan had real disinflationary tailwinds doing the work for him. In his time, you had globalization, you had fiscal surpluses, you had a genuine productivity boom from the internet. Today, we have 6% fiscal deficits, we have rising defense spending, we have a move away from globalization, I would argue, in favor of comparative advantage of each nation, and an AI productivity story, which I would argue is still a forecast, not a fact. There's a lot of CapEx spend. There's a lot of guidance that likes to talk about AI. And yes, many AI companies are productive and are profitable. But the truth is that AI is not broadly adopted. So the productivity numbers that we see right now don't have anything to do, in my opinion, or minimally to do with actual deployment of AI. The productivity numbers that we see right now here in the US, which are very good, are coming from past productivity. It's not AI really right now. I think that's something that will occur over the next 5 years. So Warsh faces a situation where the productivity story that he and others have thought could and will curb inflation aren't doing so right now and won't by year end. So he's probably going to have to hike rates. And it's not him, of course, it's a committee. So everybody wants to call for lower oil price, the lower oil prices being disinflationary because of the Iran deal. Be very careful with that. Energy, yes, drove 60% of May's CPI gain. So cheaper crude does impact immediately headline CPI, but the Fed targets PCE. And core PCE is at 3.3%. That's the highest since November 2023, and it has stopped improving. And we have second order effects, which are still in the pipeline, both from oil prices and food prices. So core PPI which is the purchasing price index, is running at 5.1%, and that feeds through into CPI over 3 to 4 quarters. So falling oil is not the same as falling inflation. So I'm not bearish. It's still a bull market, and the trend deserves respect. But when we look at the markets, and this is something that I just said on Bloomberg Television, the rally has already capitalized on most of the good news. Since the end of March, analysts on the street have raised S&P earnings by nearly 9%. And the index has rose 11% since then. So at 20 times forward earnings, you also have the equity risk premium being zero, which means you're taking equity risk for nothing over treasuries. So the equity risk premium is virtually the equivalent of the 10-year treasury yield. So the other risk that I see is the market is very narrow, and still is. We have new highs, yes, and with only about half of stocks participating, AI is producing real earnings. So we can't call a bubble something that's actually producing earnings. But semiconductors are doing most of the work. So that's a vulnerability there. Tech earnings are set to grow, according to FactSet, 60% this quarter. But semis 120%. So you strip semis out and tech growth drops from 60% to 25%. So my concern isn't AI. I think that's a real thing, and we're seeing the money. Show me the money, we're seeing the money, because a lot of these companies are profitable. So it's not the bubble in unprofitable companies, it's concentration that worries me. And that's the same lens for SpaceX too. Everyone's asking me about the SpaceX IPO. This is the largest IPO in history. It's a liquidity signal. It's not a rocket story. Markets only fund a deal that size above a $2 trillion valuation when risk appetite is exceedingly robust. That's where we are right now. This is a company losing money, losing $4.3 billion a quarter. And that's against the fair value closer to $780 billion. So this IPO feeds risk appetite, but it does absolutely nothing for concentration risk. On the contrary, it brings a risk, in my view, because it pulls more capital into mega cap growth, AI and defense, and to fund positions in this IPO, which was overallocated and people couldn't get a piece of it, but there's a need to sell other things. So here's how I'm recommending being positioned. We respect the trend, but we tighten risk control. We're overweight energy. That's the cleanest inflation hedge. We're overweight materials, financials, and gold. We need to be careful on cap-weighted, mega cap growth, and long duration tech. That is, in my view, a valuation trap. I'm not anti-AI, I'm anti-multiples. So I'm recommending underweight rate sensitive utilities, REITs, small caps. The truth is here, everyone, that we're very unlikely to get rate cuts this year. We're very likely to get rate hikes because of what I previously mentioned. Higher demand, pull inflation, and supply inflation already in the pipeline. There's nothing that a reopening of the Strait of Hormuz can do about inflation that's already in the pipeline and second order effects. We hold our gold as our hedge. Gold is down 25% off the highs. I still like it. I think that's a rates issue. I don't think it's a structural call on gold. Central banks continue to buy it. I like it as a hedge on Fed credibility. Even after it's pulled back, central banks, I like it because central banks keep buying. That's real demand. So my view changes if three things happen together, I would say. Oil prices collapse and remain so. Inflation expectations suddenly drop. And the labor market softens materially. Okay, I'm not talking about what we've seen, which is gradual, 10 basis points of increase in the unemployment rate. I'm talking about 5%, above 5%. That gets me worried, and there the Fed starts to cut. Until then, everyone, this is an overheating risk market, in my view. Okay, you have the wealth effect, you have consumption, you have massive amounts of investment, you have government spending inordinate. You have a lot of factors here, especially real growth, showing that this call has been correct, and that the conversation has been quietly and now is explicitly shifting from cuts to hikes. So watch real yields. If they go down, the equity markets can continue to move. Okay. If credit spreads, oil and earnings breadth all improve, the rally broadens out. If they don't, then today's narrow leadership is a vulnerability. So thanks very much. I'm Kathryn Rooney Vera for StoneX, and please follow us. Appreciate your time.